Hello everyone. So today we are going to talk about where the stock market is headed after today's Fed meeting. So if you look at the today's chart, this is the SPX, this is S&P 500. So we started around 3850, and just before the Fed announcement today, the market interpreted that Fed is going to pause, but that was before only after the press release, but before the press conference, and we were all the way up to here 3891. And then after the press conference with this hawkish Fed, when the Fed said that they're nowhere close to pause, and they see that there'll be ongoing rate increase until the inflation is below 2%. So that's sort of again the same story, that they are deja vu, that every time Fed came out and market reacted with a 1 to 2%, around 1.8% of decline. And that is basically what happened today. So we went down around 3760 was the close today. So 3759. So here, this is what is important. So this reaction, today's reaction, it could be an overkill. It could be reversed a little bit tomorrow, because it already shows the SPY, the futures for both for the Nasdaq as well as for S&P is a little bit up. So today's reaction was as basically overreacting to Fed's narrative that literally what the Fed said, that they were not going to pause in the near few weeks, right? And that basically the market took it to the heart, and then it started reversing right after the Fed pause. But if you look at where the long term we are headed, and that's mainly the intention of this video. So even if we have a reversal tomorrow, here is where we are going. So here, if you go to the weekly chart and see every time in the bear market, this indicates this was the 2000s bear market. So we went all the way from the S&P level around 1467 to all the way down, corresponding to this point, that was around 771. And how long does it take? It took about, if you go to the measurements here, so from the top at May 2000 to all the way to 2003 when the market bottomed, it took 922 days, so around 3 years. Again, the next one, and how much actually market declined, that was 49%, so almost 50% decline. Go again here, that was back in July 2000, August 2007 when we had this market peak, call it July 2007, and from there we had the 2009 March where we had this. 2 years later, this market bottom, 54% down from the peak to the bottom to the trough. And how long did it take to bottom the market? That was 573 days, a little lower than 2000's the valuation correction of the 2002 bubble of the all the tech stocks. So that took around 1000 days, and this one took around 559 days, so almost double the time for the first one. Now let's see where we are here. So since then we had 1, 2, 3, 4, 5, 6 corrections, and each of these corrections, if you look at 2009, 2011, so 2 years, 11, let's call it here is 1 year, and then 11, and then 16, 5 years, then 16, 18, 2 years, and another 2 years. And then we had this after 2020, we did not have a correction. So typically you'll see every couple of years, we would accept this exception of 2012 to 2016. This 4 years was like, Obama era was a real boom. After that, this is the Trump era started, and we had a real boom. After this, what is it called? The animal spirit or whatever they're calling at the time. Anyway, so 2016 all the way until Trump announced this, trade war with China, and then we had the sharp connection after this increment of this when Fed started the QT and the interest rate increase, and that was in December 2018 where we had the sharp correction. And then again the correction, or rather sharp recession at the COVID, and then we had this all the way up. This bubble built up. This bubble, if you look at the size of this bubble, is 49% burst here in 2000, but this one is much higher. So if I measure it at the price range, so this was actually the bubble. If you consider from this correction, it was 45%. So yeah, about the same. So 45% higher market went from the 2000. And if you consider that just from the high of the before the COVID high, then it's still around 25% higher. So that's quite a bit of like bubble to burst. And if you look at it, like we are in that process. So it is inevitable that we are going to correct. The stock market is going to go to this level. So if it actually does burst tomorrow, for example, in next week or so, then we're going around 3100, 3130. But if it takes a little bit, and then let's say it goes all the way to one more year, September 23, that is about around 11 months from now, then we're going to 3200, 3227. So that's where we are meeting this trend line. When you see this correction, every time it actually touches every couple of years over here. Now, interesting thing is that this, if you look at the slope of this line versus the slope of this, the previous lines when the interest rate was much higher. So 2009 onwards, we had 0% interest rate. So the asset bubble started to build up. But if you look at like the stock market's history, I think we have this in this chart from 1979, maybe even before. We had never this sort of bubble ever built up. So 1990s, 94. So here we had a slope, but this slope, if you look at the slope's angle, this one versus if you look at like current slope, they are sort of similar or even a little bit higher, I would say. So it's very likely that we are going to see, and even if you look at the one after 2000 to this, so we have a slope 2000 to 2028, 2008 with the financial bubble, but here after this COVID, the slope is right here. So it's almost 60 degree versus 30 degree for the other slope. When that happens, we are supposed to have a even like a bigger burst. So my guess is that all technicians who were this all today, they are predicting that we are definitely going to go to this 3200 level, maybe 3100 level if we burst very before the end of this year. And that is possible because everybody is saying that we are going to actually see overall seasonal buying around the Christmas, which is like strong seasonal tailwind, if you call it. But if that happens, then that's one story. But then again, in this year, we have a lot of tax harvesting that's going to happen. A lot of people I talk to, they are planning to do tax harvesting, and now even in the in the mainstream media, they started talking about it. So if you consider that all these tech stocks where people have lost money or people are expecting to lose more money in the next year, they are going to sell, and that is going to further cause a decline in the QQQ. We'll go there in a second, and the QQQ, which is even worse story. But let's say even if that will bring down the S&P, like the Apples and the others, the Googles, if they get sold off, then maybe we'll hit this by the year end, by December 27, 2022. Let's say we're going to go at 3200, right? And that would complete the correction, and maybe after that we're going to pick up from there on. The pace will be picking up, and then we might go revisit again that 4800. That's going to be a good case scenario. Another scenario is if you consider this line further down, right? We don't have to go all the way to 2030, but let's say that we talked about this. This was like this took 559 days. So if I measure this, like how long will it take for this bubble to burst? Let's say we take, because it's a bigger bubble, it is supposed to burst quicker, even quicker than this one. So let's say it takes around 300 days, right? let's say 559 is our baseline, and then we can go from there and see that from here to the bubble to form, it took 652 days, right? So this is from the there's some COVID low all the way up to the Jan 2022 when you got this 4818 as S&P high. Now just replicate that 637 days where we land in that case. So here from where we started this bursting this bubble, and you go to 630 days or so, and you were in the November 2023. So here, somewhere around here, right? 616 days, let's call it this. So around that area, so here, we are going to burst this bubble all the way up from the COVID high. So from the COVID low, where we, this line, and to this. So if you look at this, here is a shoulder. So let me create this shoulder pattern, head and shoulder pattern. So we might be forming a head and shoulder in the S&P. This is one left shoulder, this is the right shoulder, and it's possible that, let's say this is the left shoulder, this is the head, and it can go all the way up to here, right? And that is where we are going to hit this, around September 23 maybe. But we might go back up, try to reach this 3750 or around this Fibonacci 50%, 3500, and we fail there. And what do? We go back to this COVID low. And when that happens, if you look at the slope, around September 2025, if you have a lower slope, if the things are really worse at the time, then maybe January 2025. So this whole process that started back in December 18, when Fed started raising this interest rate, and then we had this COVID high, COVID low, then we recovered with all this stimulus money. We are in the process of the first correction to the shoulder line, to this trend line of this bull trend line, and then maybe next year we are going to go up, but somewhere around 2024 we'll find that the earnings are really in a worse situation than 1 year ago, and stock gets sold off again. There will be multiple different scenarios. This could be a China attacking Taiwan, it could be some other geopolitical issues, it could be election, a bunch of other things, and then we form this shoulder potentially. I mean, this is not yet formed, but it might be going there. In that case, we go to where? 2700. Now interestingly, around 2700, right? So if you look at, let's delete that one first, and then let me tell you something else as well. So if you go here and take a look at this Fibonacci series, so here I draw a Fibonacci based on this low, which is back in 2009 when we formed this after the financial crisis, where we started this rate increase, right? The QE, the quantitative easing, and 0% interest rate, and that's where this bull market started. And the bull market picked after this COVID, and then the burst has started. And if you consider this is the top, and this bull market ended over here in December 2021 with this, or January 2021 with this 4818, and in this bull market, this secular bull market ended here. So then this is the low, 656, the great financial crisis low. This is the high, which is 4769 high, right? 4818 high. And what is the 50% retracement? 2706, right? And what is the head and shoulder? If I go back to the head and shoulder again and form this head and shoulder one more time, 1, 2, left shoulder, right shoulder, and then some form of left shoulder, and here we hit this line. Why this line? What is the significance of this line? It is around 2706. And why are we going to hit specifically this line? Well, it may not be this exactly same one, but this sort of forms this neckline that that we think might be this. So you can actually also see this thing getting tested around this November 2024, and it breaks, and at the Fibonacci 50%, we might actually bottom. And this bottoming process which started in 2022 January, that ends around 2025 July. And at that time, after every bear market, we come out of a new era. Like after the 2000s, we came out of this era of computers, right? And there's the PCs and the websites and the web, basically 1.0. With the 2008-2009 financial crisis, we come out of 2008 financial crisis over here. We became the mobile era over here, and that continued for about close to 15 years. And now, with the end of this era, which started there on the financial side, it is going to be an end of this 0% interest rate and the QE. And on the technology side, we might come out of this as bolstered with the cryptocurrency being more matured, and the automated car and the AI, and that era of maybe some initial commercialization of the quantum computing. So all those like cool stuff that's being developed now but not ready for commercialization. Maybe even Meta goes with their metaverse around the time. So 2025 we come out of this bear market that started here in 2022. So it's going to take 3 years, and that's kind of my the real doomsday theory here, that we are headed there. So if you look at the chart, forget about this this hypothetical scenario of head and shoulder, but although this is very, very interesting, but let's say if you look at the chart, there is no way I can think of that, given all the situations going on, that we are not going to test it. So 3200 is a given here, 3174, if you consider, depending on your timeline, if it's next year, October, maybe 3174, maybe lower, if you're considering this, bottom forms, but, sooner than that. So during this time, we're going to continue to see this grind. But let's say we go there, then what happens? Interest rate at this time, obviously, is going to stay around 5%. And are we considering that we are going to at this high interest rate, we're going to go back up over here? The growth will be back? No, for sure, right? So we're going to go back and test this maybe around this 2024 January, and until then we're going to have a good rally from 3200 all the way to 3700, 600 points. And maybe that will be the end of the 2020. We are probably going to be ending 2020. Let's say we end 2021 around this level of 3500, 3400, and then we go all the way back, and then it still have a little bit of good progress. So everybody say, okay, we got some positives from the 2023, and right in there we get this 2024, and we see that all the earnings are bad. So we go back down again, and there we hit this 2020, the Fibonacci 50%. So that's my take. But now let's go back, corroborate this theory again with the QQQ. Okay, so this whole Nasdaq QQQ actually is that kind of shows you that why it is also possible. So another head and shoulder, if you consider that one shoulder, left shoulder, is a head, and if it goes down, so this is basically right now QQQ is around 265. So it went all the way. So August it was 290 or 300-ish, right? 333. Oh no, not 333. I think it was around here. Yeah, I can believe it was 333 in August. Okay, I might have missed it. But anyway, And then we had a sharp decline in the weekly, and we actually were right now around 265. But if you consider, before the COVID, back in 2020 March, we were at 166, and pre-COVID, before the boom, we were on the same level, and we went up to 235 in 2019 when the interest rate was zero. QQQ is so sensitive to the interest rate. Now interest rate is high, so it is imperative that we are going to test this 236. Right now it's 265, this 236. That's a 30-point down. And then this QQQ is consisting of this Apple's, the Meta, the Facebook, the Google, all the Adobe, and all these tech stocks. So what is the conclusion? The tech stock has a way more way down. So 26 points here, just by the Q1 next year. So that's around 30 points, so around 10% down from here. But will that stop there? I don't know. My guess is it's going to go test this one, because that's where we are forming this head again, right? And then we are going to see that if we are going to form another shoulder or not. So that is a next scenario. So maybe around that kind of goes hand in hand with the S&P chart that we showed earlier, that the S&P chart, that as it shows that it might be possibility of the head and shoulder in 2024. Maybe we'll also see that, but at the time, look at the level of the QQQ is 236. But if you go test the lower one, that is the shoulder's neckline. This is not the neckline, this is just testing the previous shoulder. So this is the bounce line. So this is the best case scenario. That's 235. You're definitely going there. Now if we actually go down from there, which is highly possible, 50% probability, then we are going to test the 178 level, right? And that's where we can bounce maybe back based on the slope, maybe around next year, July, maybe summer. But if we feel that bounce and form another right shoulder, we are probably going to be, again, same story, 2024 September, October, we go all the way down here to 136. What happens? That's a half, 230, 265 to 130. That is around 50% down. So Meta stock $45, Google stock $45, Apple stock maybe $100. Adobe stock, wow, that's $150. Look at Amazon stocks right now at 92. Maybe you'll get a better deal in 2024 if you wait until then, and if you all have a job and if you have money to pay for the stock, then maybe Amazon stock will get at $45, right? Considering that all linearly falling along with the QQQ. So if that happens, right? So let's draw Fibonacci and see that. So my bounce line is this green line at 134. And the timeline is December 18. Remember December 18 when we had this huge, like a correction that happened, and then Powell, he just U-turned, and based on that, that U-turn is probably coming in next September, and that's where we're going to have the bounce from the 3100 or from the shoulder on the S&P, and then we're going to see after the bounce we're going to fall again in 2024. Everybody's saying 2023 will be a great year. I doubt it. I think it's going to be the terrible year. And 2022 is just the preview of 2023. Okay, let's go in the Fibonacci from here to 50% is 275. So right now we are around 265. We still breached 275, and then we are going to go to 244 next, 205. And if you look at the 205 here, so if it's a symmetrical angle, then probably around June 24 we're going to 205, right? So we are going to test first this 235 level by sometime mid next year, and then we are going to go up the right shoulder and fall again around here. That's going to be around next year, as I was earlier mentioning with S&P. So that's my theory. So what's the strategy? There is no strategy. Either you have cash. I invested all my cash, thinking that we are going to get a bounce of the Meta, but that's where my bunch of this cash is stuck. So now either I take loss or I hold, and based on that, I think a right strategy is to short. It's obvious that you have to short, but shorting is also very painful, because if you hold 3 years, your Meta and Amazon or your other stocks, if you can hold until 2025, yes, it's going to cut in half, but it is going to come back. I mean, if you can hold for 5, 6 years, 7 years. But if you short, and let's say that you have a bounce on the meta on news like China and like the TikTok ban or whatever, and at that time, from the $90 stock, it pops to 200, but it'll go back again 90 probably at some point. But the amount of the pain you have to go through for your leveraged account when it pops, it's untenable. So shorting stock always has a risk, but that's the only way to make money if you're in this market. There is no other way. There are other stocks which are high value, very good value right now. I know if you look at the financial, if you look at the XBIs and the bio stocks, if you look at the industrials, they're all in a good valuation. But it doesn't matter if the S&P is going down to 3200. We are going along with it. So every stocks is going along with it. The tech stocks is going to have an even terrible time because it's written on the stone that it is going to actually go cut in half a couple of years from now, it looks like. But so will be this bull trend line on the S&P that is going on. It is going to be broken. It looks like. And the question is when. My guess is around this blue line. That is where we're going to see that 3200, 3160. That is going to be September next year. And then you're going to form its head and shoulder. And then you're going to test and break this bull line, secular bull trend that it calls, that started in 2008. 2009, it is going to be ending around September 24 or end of 24, and then in 2025 you're going to see a new bull market that gets formed with a better valuation and with a new technology emerging out of it, both crypto wise as well as from the AI and the automotive space. So that's all for today. Doomsday theory, but I think there is a lot of value to know that where we're headed. So don't buy the dip. That's the bottom line.